Hello, good morning, good day, good evening, depending on when you listen to this. Welcome to another Africa iShare podcast. So this is the podcast for the month of May 2024. So we'll be posting just slightly later than May. Yeah, and apologies for that. So today I wanted us to cover quite what maybe an interesting topic, especially for anyone who follows things about economies in Africa and what's happening uh, in the in various African economies, and also like what's the future of that. So one of the biggest things that happens is happening right now is the issue of taxation. So and and taxation in the sense that there's an increase of the amount of taxes that are being paid, especially within African countries. So uh, like in Kenya, where I'm based at the moment, um, if you're importing anything right now, like even the amount of duty you're likely to pay is quite significant. And in fact, just recently, a friend of mine was importing something from South Africa, and the amount of duty that they were asked to pay, I mean, it left us wondering, like, is it even worth it? Would you rather not have this item like go to Tanzania and then pick it from there? I mean, depending on how much duty Tanzania is charging. But another thing is that the different levies that right now are being charged, even on employment income, uh, um, things, what is it called? The affordable housing levy, for instance. Then there's the levies that are being charged on fuel, quite high. Eh? So then in the last podcast, I had mentioned that while all this is happening, Kenya took the direction that they will discontinue digital services tax in favor of the OECD solution. By the way, that let's wait and see if actually Kenya would discontinue the digital service tax, because that was said in March of 2023. You would expect that in the finance bill for that was released a couple of weeks ago, that Kenya will be scrapping off digital service tax. Like what we are expecting is that the finance bill will be saying something like delete the provisions for digital service tax. But instead, what has happened is that there has been a, a new tax of the same nature as a digital service tax, which is now called the significant economic presence tax, which is being introduced. Like in the Finance Bill 2024, there is a significant um, economic presence tax. So this is similar to what is charged in Nigeria, or at least last I checked. I mean, I've realized that a lot changes like so quickly that the information that I had as of 2023 might have been overtaken by events right now, especially with digital taxes, because of how much it's changing. So uh, let's wait and see if Kenya is really going to discontinue the digital service tax. But discontinuing the digital service tax is of key concern to the US, because anyone who's followed the global debate, especially even at the OECD, is that um, the US has been saying that US entities are the ones that are unfairly targeted by digital taxes, and therefore um, they want digital taxes discontinued. In fact, the US in the OECD solution, which we'll be speaking about right now, the OECD solution for tackling the digital economy, the OECD had proposed two like two pillar solutions. Yeah. So in pillar one, initially before the US came in, pillar one was to only deal with digital businesses. The US came in and said, no, 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 no. We will this pillar one will not only deal with digital businesses, it will deal with all businesses that reach a certain level of threshold, yeah, which was agreed at €1 billion. And then for pillar two, it's any entities that will come with will have a revenue of €750 million. So the only industries that were excluded were the extractive and the finance sector. So basically, what the OECD is giving as a global solution to tackling the digital economy is not a solution to tackling the digital economy. It's a solution to taxing the companies that happen to have the highest level of revenues. In fact, it has been estimated that only 100 globally entities will fall into that category. And again, they are not all digital companies or entities that will fall within that category that will come within the OECD solution. That's one. And fair enough, like some of the entities that have the highest revenues globally might be digital businesses. Alphabet, meaning Google, for instance, Apple, for instance, they might likely, very likely, fall like Google will fall there. But that's it. What the OECD is proposing is not a solution to tackling the digital economy. It's a solution to taxing entities with the highest level of revenues globally. But that said, today I wanted us to look at again a little bit of the same issue of taxation. But I don't know if anyone has heard that there's a global minimum tax. That this was news maybe in 2022. There was a global minimum tax of 15%. I wonder if anyone wondered how does a global minimum tax work? Like when you say there's a minimum global tax of 15% on an entity, what does that mean? Because one, the corporation tax rate for Kenya is more than 15%. It has been at 30%. Yeah, is at 30%. So when you say there's a global minimum tax of 15%, I mean, are you saying that you'd rather fall within that global minimum tax and instead of Kenya corporate tax, so you're being charged 30%? Or what is a global minimum tax, and who is going to apply this global minimum tax? So let me just basically summarize what the idea is of global minimum tax. The global minimum tax is that tax that for incomes that are untaxed or undertaxed at less than 15%. The idea is that to ensure those revenues are at a minimum tax at 15% wherever those uh, revenues fall. So if you're in Kenya and Kenya doesn't tax you at 15%, Spain should tax you at 15%. If Kenya taxes you at 10%, then the UK, if it has access to the same income, it should be able to tax you for the difference of 5%. So in essence, what is being said is that you can be sure that all income that's being accrued from anywhere in the world, at the bare minimum, someone is paying 15% tax on it. But let's go look at some of the quite interesting things. So like what's on the screen is the OECD, which I've referenced, OECD G20 BEPS project, tax challenges arising from digitalization of the economy. So this is what is called the GLOBE model rules. This is the pillar two, which I mentioned. Yeah. So OECD have come up with these two pillar solutions of how to tax the digital economy, which again, as I've said, it's really not to tax the digital economy. The fair thing to call it is to tax the most the entities with the highest revenues. And this is pillar two, yeah. So pillar two is the one that provides for global minimum tax. So a lot is said by OECD. In fact, this document is quite long, as you can see in this table of contents. It goes to at least 67 pages, and then there's executive summary and all that. But what I wanted to do is highlight for you, just so that you know where all this is coming from. So the GLOBE rules provide for a coordinated system of taxation intended to ensure large multinational enterprises, M&As, group, pay a minimum level of tax on the income arising in each of the jurisdictions where they operate. So, as I said, the goal is to ensure large M&As pay a minimum level of tax on the income arising in each jurisdiction. Yeah. So, so that's basically what a minimum tax is targeting. Like if you are a large M&A, you must be paying a minimum of tax on the revenue uh, for for in each of the jurisdictions where you operate. Again, the examples I gave. Let's say the UK. The UK gives you a tax benefit, yeah, and tells you as Apple, you can pay a tax of 10% in the UK for, let's say, certain revenues that Apple is earning in the UK. So that's 10%. But there's a requirement that it should be at a minimum of 15%. So what happens is, which we will cover next, is that another jurisdiction or another country will be allowed to charge a top-up tax on the 10% that was not charged in the UK. So, as I had said, the globe rules apply to entities that are members of an M&A with an annual revenue of 750 million euros. So this is pillar 2. For an entity to fall within these rules, for an entity to be required to pay a minimum of 15% global tax, they must earn at least a consolidated revenue of 750 million euros. But there's also another angle where you say, so let's say for instance, there's Google has different what are they called, constituent entities or constituent business lines, yeah. So there's like Google Cloud, and then there is like YouTube, and then there is the search engine. So let's say the search engine by itself is making 750 million in revenue, yeah, annually, euros. But then YouTube is not is making it is in a loss. And then let's say cloud services are making, let's say, like 750 million also. So what's suggested is that the different, if the line of business that's making 750 million will will come within the rules. This is irrespective of the fact that, because let's say once the consolidated financials are put in place, the YouTube loss is eat up on the revenues that are earned by the search engine and the cloud services. So that might mean that when reporting its entire global income in a consolidated financial statement, Google may say that we are not falling within the 750 million. But what it said is that if one of your business lines or constituent entities is meeting the threshold, then that uh, constituent entity or line will fall within. So in that example, Google search engine will fall within globe rules, even if YouTube will not. So and then what happens is that if the Google search engine falls within the rules, it means that it should pay at a minimum 15% minimum tax in each of the jurisdiction where it's accruing this revenue. So quite a bit of definitions, and you can get all this information here. But also there are certain entities that will not be included in these rules, which are called excluded entities. So this is like a government entity, an international organization, think of UN, think of any international organization really. They cannot come or they will not come within these rules. Even a non-profit organizations, a pension fund, an investment fund, a real estate rate investment vehicle that not rate, a real estate investment vehicle that is an ultimate parenting. So there's some exclusions there, but this is important, like especially if you are interested in this topic. This is a very helpful document. And then there is, okay, now let's go to the next thing, which is this part that deals with, so who should tax? Yeah. So let's say Kenya gives someone who is investing in a special economic zone, tells you, let's say Apple, you set up within the special economic zone to assemble iPhones. We will not charge you any tax. You'll get any revenues that you make from your entity in Kenya will be taxed at 0%. But globally, we're saying there should be a minimum of 15%, uh, 15% tax for in each of the countries where Apple is operating. So what happens? What happens is that the income that is leaving Kenya untaxed will have to be taxed somewhere else. So in short, is if you Kenya decide to give a special economic zone and a benefit to someone, that's upon you. Someone else will tax that income. Yeah. And we'll make sure that they are taxed at least 15% minimum tax. So in short is if there are countries which are forfeiting their taxing rights, then someone else will take those taxing rights. But how is that going to be done? So let's go again to the example of Apple being operating in a special economic zone, let's say in Dubai. Then it's operating and it's not being taxed at all. What happens is that the parent company located in the US, yes, assuming it's located in the US, which I think it might be, uh, it will top up. What it will do is that it will be entitled to tax the income, the income that's coming from profits coming from Dubai are tax free. The ultimate parent company will tax it at 15%. So what that means is that it's in the interest of Dubai. Either way, it's the income that the untaxed profits leaving Dubai will be taxed. So it's in the interest of Dubai to make sure that it taxes that income. Because what happens is, if you don't tax it in the source country where these profits are coming from, if you don't tax it in the source country, it's going to be taxed in the country of residence of this um, of this of this entity. So in fact, let me show you quite a bit of so ATAF is the Africa Tax Administrative Forum, yeah, and it comes up with rules about advising African countries about different things of um, how to approach some of these things. Especially now, it has been spearheading the discussions that have to do with the OECD and these rules that the OECD is coming up with. So this is a very important, I would say, and very informative guideline that's coming from ATAF on this issue of the global minimum tax. So, and this is what they say. The globe rules comprise of two interlocking domestic rules, an income inclusion rule, which imposes a top-up tax on a parent entity in respect of the low taxed income of a member of the multinational, and an under-taxed profits rule. My apologies. So this is the second rule. So there's the income inclusion rule and the under-taxed profits rule. The rule that and they don't operate as alternatives. The income inclusion rule takes precedence over the under-taxed profits rule. And the income inclusion rule, important is that, which is what ITAF is saying here, where I'm highlighting, is that it is important to bear in mind that the income inclusion rule and the under-taxed profits rule will enable jurisdictions to collect top-up tax in respect of low tax outcomes, e.g. those generated by granting of tax incentives, whether or not the constituent entities or multinational enterprises are located uh, in countries that are inclusive framework members or not. Basically, is that these two rules will enable a country to go and collect a top-up tax in respect of low tax outcomes. And I think for African countries, the issue there is that most African countries, whether it's South Africa, whether it's Ethiopia, whether it's Uganda, Tanzania, Rwanda, their tax incentives. In fact, it has been a case where something called race to the bottom, yeah, where Kenya has a special economic zone that's trying to attract, let's say, um, tech tech companies. What Uganda does is that if Kenya is saying we will give you zero, you will not be taxed for, let's say, 5 years, Uganda will go and say you will not be taxed for 10 years. So it's a race to the bottom. Because you're trying to really attract foreign direct investment. What happens is that you're racing against each other and you're raising to the bottom. And so really what's happening is almost like OECD has noted this, and it has been said that what OECD might be doing also is making it harder for African countries to be able to give these tax incentives, which also makes it difficult for them to attract foreign direct incentive investment based on purely the tax incentives that you're granting. And there has been suggestions that, like within African countries, you should work on other things, including like the economic stability, political stability. You need to work on like your court systems and all that. That is going to make the investors more attracted to you in other ways other than by giving them tax incentives. Like make your road networks proper, like really invest on your networks as regards, um, you know, tech, like get good internet, do all these things rather than giving tax incentives, which I think makes sense, yeah. Only that I think African countries have uh, really been granting tax incentives by saying that we will not tax you if you come and set up in our jurisdiction. And that's very attractive because if you're a foreign entity and you had a branch in Kenya a year ago, you're being taxed at 37.5%, yeah. And if you are just a resident company, you're being taxed at 30%. If you're told that you're not going to be taxed for 10, 15 years, what do? You can't set up for 10, 15 years, get all the profits out of the country. Then when you reach to a taxable position, you wrap up and leave. That's what entities have been doing. And so anyway, what these rules are trying to do is that to make sure these tax incentives that were granted in that way are not granted anymore. So they the ETAF has picked a few issues, and they are, yeah. And one of the things, even as I'm speaking about these rules, is that ETAF has noted very few, if any, African country will collect the top-up tax under IRR. So that is the income inclusion rule, as most countries have very few, if any, ultimate parent companies in their country. Actually, this has been updated, and what ETAF was saying is that because the income inclusion rule is to be applied by the um, ultimate parent company, so that if I'm sitting here and I'm looking at the ultimate parent company of Apple, I'm seeing that there's a country here which is granting them 0% tax on profits leaving their country. What I do is that as Apple parent company in the US, I will tax that income which was untaxed. I'll tax it in addition to whatever other taxes that are taxable in the US. So in short, if 100 was coming from Ethiopia, which was untaxed on Apple, and there was another maybe 500 that is coming from the US, what the parent holding company will do is it will take the 100 that was not taxed in Ethiopia and tax it along with the 500 that it's taxing the US. Only that the maximum tax on the income coming from Ethiopia is 15%, and then whatever other domestic taxes would apply in the US would apply on the 500. So yeah, so that's it, and that's how that is supposed to work. But what ETAF was really trying to push for is that for source, uh, the source-based rule, which is the second rule, which is the under tax profits rule, was more preferable for African countries. Yeah. So, and I think uh, what the under tax profit rule says is that if you find that there's income that has not been taxed elsewhere, what you do is that you if it's deductions that you'll be allowed to claim in that country, you're not allowed them. If it was a treaty you're to benefit from, you not benefit from the treaty. But what happened was that when the OECD was releasing the rules on income inclusion rule and the under tax profits rule, the OECD considered and said, not considered, but said that if a source country has a qualified domestic minimum tax, which is here on the screen, then it will have first preference over the ultimate parent company. In short, what this means, and I'm reading from this ETAF note, a qualified domestic minimum top-up tax offers the opportunity to collect revenue. It allows those countries to collect the top-up tax on low tax outcomes generated by tax incentives in their own countries, rather than allowing the resident jurisdictions to collect the top-up tax through the income inclusion rule. Basically, what this means is that any African country uh, that is having a tax incentive that is allowing profits of these uh, large multinationals to leave their country without tax, they need to take out those incentives and they need to charge a qualified domestic minimum tax. Otherwise, that income, which is leaving the country untaxed, will be taxed by the ultimate parent company. And what ETAP is advising is that African countries should consider having a qualified domestic minimum top-up tax. So what and this is what ETAP notes, yeah. The globe rules may also relieve some of the pressure African countries face to grant tax incentives, which in many cases are inefficient and often wasteful. Under the globe rules, where tax incentive results in an effective corporate income tax rate of less than 15%, the globe rules will lead to another tax jurisdiction, usually the jurisdiction of the ultimate parent entity, collecting the difference between the effective tax under the tax incentive and the minimum tax rate of 15%. That is the top-up tax. That's what I was saying, yeah? If you grant a tax incentive where you're taxing anyone at less than 15%, then the ultimate parent entity is going to collect the tax between the tax incentive and the minimum tax rate of 15%. So this changes the landscape of tax competition when it comes to offering tax incentives, because those jurisdictions will not be under the same pressure to provide incentives such as tax holidays, given that the effective tax rates below 15% will only lead to a resident country collecting and retaining that tax. Yeah. So this this what the global minimum tax has done. It has changed the landscape of not only the minimum tax that can be collected, but really how tax incentives will be given by African countries. So today, I know maybe I've gone a bit over time, but that's what I wanted to speak about today. Like, what really is the global minimum tax, and how is it affecting? And this is another reading material for anyone who wants to read a bit more. There's quite a lot that has been written on this topic. But the whole thing is that there's a minimum global tax, and it may not be that as an African country, that the African country itself is going to collect that amount of money. It's almost now what you're doing is on the defense, yeah, making sure that someone else does not collect it. It may not be that you will collect it, but then no one else collects it. Make sure at least what is leaving your country is taxed at more than 15% or more. I don't know what your thoughts are, but I would love to hear them. And hopefully next time we will have someone else to share their thoughts and their opinions on this topic. But for now, it's goodbye.